So one of the tools that we use to analyze financial statement is financial ratios. What is a ratio in mathematics? Now I believe you know what are ratios. So in our case of financial accounting, ratios can be classified into, so we can classify moja, kuna zenye tunaitanga liquidity ratios. In finance, when you see the word liquid, inamaanisha nini? What about leverage or gearing ratios? Activity ratios. Then number 4, we have profitability ratios. So those are the ratios. That is how we classify. So tumesema liquidity inamaanisha nini? Whether a firm is able to meet obligations when they come due. So who are the users of ratios? We have a number of parties who are interested in analyzing the financial statements. We include the managers, shareholders, and so on. So if you can have the ratio category, who are interested in these ratios? So for example, the liquidity ratios, who are interested in the liquidity ratios? Liquidity ratio inamaanisha inapima nini? The cash availability. Sio nani wanapenda kujua? Shareholders, sindio? So that they can know whether they will be getting their dividends. Kuna suppliers, yeah, sindio? So that they can know. They are interested in the liquidity ratio. Kama hiyo kampuni iko able to pay, sindio? Kisikia kampuni yenye liquidity yake iko chini, ndio supplier companies watakulipa nini? Creditors also are interested in this. Creditors ni wenye wanatukopesha other things like fuel, electricity, and so on. We also have competitors. Leverage or gearing ratios. So when you talk about leverage or gearing ratio, inaleta what comes into your mind? It is the capital structure or capital base of the company. Okay? Whether the company is able to survive the waves. So who are interested in those? Who are the users of such? Shareholders, isn't it? Lenders, the ones who give us loans. Okay? Creditors, and also potential investors. Those are the users of gearing ratios. Activity ratios, who are the interested users here? The shareholders, of course, the management, the potential investors. Profitability, who are interested with profitability? The shareholders, of course, the management, the employees. If the company that you're working in is not profitable, don't think they will be paying you your salary from them. Those are the users. We still need to know what are these exactly. What is liquidity ratio? So this one, they measure the firm's ability to meet short-term maturing obligation as and when they fall due. So this one, they will help us, or they will help our company to meet its short-term maturing obligations when they fall due. The lower the ratio, the higher the liquidity risk, and vice versa. So if you have a poor Jew, you know how you advise to manage it. We have the leverage or gearing ratios. They measure what? the extent to which a company uses its assets over which have been financed by non-owner supplied funds. How do we utilize the assets that has been financed by other funds? So they measure the financial risk of the company. So the higher the ratio, the higher the financial risk for this one. So ukiona ratio imekuja juu na gearing ratio, ujue that company has a high financial risk. And what happens when a company has high financial risk? It can face closure, isn't it? So gearing refers to the amount of debt finance a company uses relative to its equity finance. So if you have it is a high gearing, it means that company is using more borrowed funds than what? Than its equity or its capital. So, equity ratios. This one, they measure the efficiency with which a firm uses its asset to generate sales. So they are also called the turnover ratios, and they indicate the rate at which the assets are converted into sales. So the rates at which you convert the assets into sales, the rate at which you are converting the inventory into sales. Kama inventory inakuja, ina take long before it becomes a sale, then that means what? There is a problem somewhere. Profitability ratio, on the other hand, they measure the management's effectiveness as shown by the return generated on sales and investment. So they indicate how successful management has been in generating profit. So profitability ratio ikikuwa juu inaoneshana the management has been efficient in generating profit. Then you have investment. Kuandika investment. Investment or equity ratio. This one now, it measures what? They are used to evaluate the overall performance of the company, like determining the company's dividend policy, or to determine the value of the company's security. And they can also use to predict the effects of rights issue. We talked about the issue of shares, the rights issue, isn't it? It's required against right issue for forfeiture. What are rights issue? When a company is continuing in its operation, sometimes it can need to add more capital. So they want to sell more shares, okay? And instead of selling to new shareholders, they decided to sell to the existing shareholders on pro rata basis. What do you mean by pro rata? Maybe they will give one share for every 3 held. So kama kuna share 3, tunakuzia moja. Alafu tunakuzia, if they are worth 100 shillings, and because we are selling to our shareholders, existing shareholders, we sell to them maybe even at a discount. So when they are formulating such policies, they use what? The investment or the equity ratios. Then, to go to our ratios, turudi tena kwa liquidity ratio. Tumesema liquidity ratio measures what? The firm's ability to meet its short-term maturing obligation as and when they fall due. Okay? Kama unaweza kulipa madeni yako ikifika ni mwisho wa mwezi nilipe rent, nilipe stima. That is what we mean by liquidity ratio. If the company or the firm is able to meet such obligations, okay? Short-term maturing obligations, salaries, rent, electricity, water, okay, when they fall due. So, when now you come to liquidity ratio, number one of the liquidity ratio, it is the current ratio. Current ratio, it is computed by dividing the total current assets by the total current liabilities. So current ratio is equal to current assets over current liabilities. The current ratio of more than one means that the company has more current assets than current liabilities. Okay. Yeah, if it becomes or 2 to 1. If it is 1 or more, it means the company has more current assets than current liabilities. Another liquidity ratio that we have, it is acid test ratio. Acid test or quick ratio is calculated by dividing the total current liabilities excluding acid inventory. You divide by current liabilities. So, a firm which has a satisfactory current ratio may actually be in a poor liquidity position when inventories form most of the total current assets. That is why we exclude inventory. Because a firm which has, or when the inventory is the most part of the current asset, then that one can indicate a problem. Yeah, when the firm has a lot of current assets, a lot of stock, inamaanisha nini? Hawauzi. Sikununua ati wakinunua, wananunua stock sana. Kuwa hawauzi. Kwa nini? There is a problem. So asset test ratio is equals to current assets minus stock or less stock, less inventory. Miracle. Divide by current liabilities. So each could be a different figure that will show that whether that business is doing well. Let's go to gearing or leverage ratios. One of them is what we call capital gearing ratio. In other words, this one is called debt ratio. It measures the proportion of debt financed to capital employed by a company. So a company is highly geared if the ratio is greater than 50. So then we say that company is highly geared. Yeah, pesa nyingi zenye inaoperate nazo ni za madeni. So debt ratio is equal to total long-term debt divided by capital employed times 100%. So it becomes in a percentage. So if it is more than 50%, then that company is highly geared. So we have another gearing ratio. It is debt equity ratio. So that equity ratio, it measures the proportion of non-owner supplied funds to owners' contribution to the company. That is, the proportion of the funds that come from other sources compared to the funds that are owned by the company. So a company is very geared if the equity or if the debt equity ratio is greater than 100%. So debt equity ratio is equal to long-term debt divided by equity. Then we have times interest cover. This one, it shows the number of times earnings by a company cover its current payments. So it shows how many times the earnings that the company is getting can cover the current payments. Yeah? How much we are getting right now, does it cover our expenses? Our bills, it's all. To know that, you use the times interest cover. And the higher the ratio, the lower the gearing position. That means it has a lower financial risk. So times interest cover is earning before interest and tax. You add depreciation over interest charges. Sasa wakati tulifanya kampani ya campus, kwa company accounts, I remember when you get the net profit, inakuwa ni net profit before interest and tax. Okay? After sasa expenses, ndio? Then you pay what? Interest. Interest on what? Debenture interest. So, then tax. Okay? And so on. So that is when you take this. Then you add depreciation. Why? When you are coming to the earnings before, earnings is net profit. When you are coming to get the net profit, you deducted depreciation as an expense. Sindio? Inamaanisha vitoa pesa ukaenda kwa depreciation. It's called an unmovement of funds. Sindio? Haikuenda lakini tulitoa kama expense. So you have to add it back so that you get a realistic figure of the number of times the earnings by a company can cover what? The current payments. That is the gearing ratio. Then kuna ingine hapa, profitability ratio. What does it measure? Profitability measures what? The management effectiveness as shown by what? The returns generated from sales. So one of them is the return on capital employed. You don't know, say. Return on capital employed, it measures the efficiency with which the company uses the long-term funds or the permanent assets to generate returns to the shareholders. So the return on capital employed will show how much you're using the long-term funds and the assets to generate money. So it is given by profit before interest and tax. The operating profit is the profit before interest and tax over the total capital employed. What is capital employed? Capital employed consists of shareholders' funds, that is the ordinary share capital, preference share capital, share premium, and retained earnings. We also include the long-term debt. Those things zinakuwa pale kwa capital and equity pale chini kwa statement of financial position. That is capital employed, financed by. We have equity, we have ordinary share capital, preference share capital, share premium, retained earning, and long-term debt. So capital employed can also be calculated as what? Fixed assets plus the net working capital. What is working capital? End up a statement of financial position. When you are solving mambo different, sindio? Sinakuwa na assets. Zinaanza na non-current assets. Sindio? And then current assets. Sindio? You add them. You get what? Then you go to equity and liabilities, isn't it? So this is capital employed. So you can also calculate capital employed like this, isn't it? Equity and liability, here you have ordinary share capital, preference share capital, retained earnings, sindio, na loan, na current liabilities. Hizi vitu zote ukiacha. See, inakuwa sema hii. Yeah. So to get capital employed, you can use this or you can use this. So, yeah. Then, that is one profitability ratio. Another profitability ratio. Kuna net profit margin, no gross profit margin.